Look, not a great session, but maybe not as bad as maybe some had feared, particularly from that Wall Street lead.
James, compared to our overseas peers, not too bad at all for the Australian market. We saw the Italian share market down by 5% overnight, the Spanish market down by 3%, and the US market down by 1.9%. And in comparison, the Australian market falling 1.1%. So not looking too bad, but our volumes were very weak today. We're still on Easter holiday volumes. It looks like a lot of the market's still away on an extended holiday. If we have a look at volumes going through the market today, only $4 billion being traded. That compares to an average volume in the month of March of $4.8 billion, so down around about 17% from the averages that we saw in March. Having said that, in terms of technicals, it was a pretty big day. We saw the 50-day moving average on the Australian market at 4,269 points being broken, and just a few points away from that 200-day moving average at 4,238 points. So that's going to be the important level in coming days. And of course, BHP Billiton, the biggest stock on our market, being watched very closely. And if we have a look at BHP, this is the one-year chart for BHP, you can see that we've jumped off that $34 level 7 times in the last 8 months. Unfortunately, we've broken through that very important support level, finishing the day on the lows of the session at $33.59. That's actually the lowest price of BHP that we've seen since 2009. So that commodity space not looking to crash off. We've also seen Newcrest Mining this week reaching the lowest level that was seen since 2009, but the rise that we saw in gold prices overnight has helped Newcrest a little bit today, up by just 0.2%. So altogether, the Australian market not looking too great today. All sectors were trading down lower, but a lot better than our overseas counterparts.
Was it a bit of a false start in terms of the big run-up we've seen in equities? I mean, David made mention of the market, our market poised at a precipice, if you like, and John obviously talking about speculation potentially previously of a US bond bubble bursting, but as he says, we've seen a bit of a run-up.
One of the things which really helped markets up in the first quarter of the year was the LTRO operations that we saw both in December and then again in February, coming out to really support the market and put those European worries into the background. We also saw that Greece restructuring, and that helped markets get ahead and focus in on earnings. But once again, we are seeing that European situation and the rising tension in European credit markets impacting on sentiment and the market. So a sense of deja vu there, where we have seen the credit default spreads for Spain rising back to previous highs. And if we have a look at the 10-year yields for Spain overnight, rising just above that 6% mark, which is within 50 basis points of an all-time high. And if we have a look at the Italian versus German spreads, we saw that blowing out to 400 basis points as well. So this is something that the market's going to be watching very closely. It looks like the effects of the LTRO and the extra liquidity are starting to wear off. And of course, we saw that European Central Bank decision last week saying that the risks are to inflation, indicating that they would be quite cautious in injecting more liquidity into the euro area. So the market's looking, I guess, at the monetary decisions all over the world. And the US, we saw the FOMC minutes indicating no QE3, no liquidity to come out of the Eurozone according to the last ECB decision. And I guess the market's starting to get a little bit more jittery. So in terms of sentiment, once again watching that Eurozone situation as well as the moves of the central banks, and it does look like we've seen a strong move into those safe haven assets today.
Investors out there thinking, well, you know, what is a good way to look at potentially playing this type of a market? I mean, is it a case for being in cash? Is it a case for maybe looking at domestic defensive? We've seen Woolworths do pretty well over the last couple of days. I mean, what's your preference?
Well, we've become well practiced to this type of market over the last 3 to 5 years. So having a look at this type of market is very much a risk-off market, and it is those safe haven areas which outperform. I mean, you just have to look to last year and where the best performing sector was, and that was the telecom sector, Telstra, with its very strong yields. So having a look at those defensive areas of telecom, of utilities, the healthcare and the consumer staples space, this is the area which outperforms when we are seeing a falling market. The key to this market, though, is watching those European credit markets, because it is when those 10-year yields get to around about the 8% level that we have seen those sovereigns having to go out and get a bailout. So Portugal, when it got to about 8%, it received its bailout. Its 10 years are at about 13.5% now, so watching for a potential second bailout there. So I think the key is that as long as the European credit markets remain stable and we don't see a huge huge jump in these credit markets, then the market's going to focus in on earnings. But of course, with the big moves that we're seeing in those European credit markets, that's really what's hit sentiment. So the key for longer term investors is to watch that credit market, because if we continue to see rising tension in those European credit markets, then it will be very much that defensive strategy that wins out.
Indeed.